You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today we're going to be talking about financing options and how it changes your tax strategy. So one of the most common questions that I get asked or that I see that's thrown out online is, does it matter whether I finance the property using a conventional loan, a secondary home loan, an investment loan, a DSCR loan? Today we're going to talk about how the financing changes your tax situation. And if you wanted to skip the entire episode, I'll just be blunt, it doesn't. It does not change your situation. A high-level overview, the tax man does not care how you acquire the loan or how you acquire the property. You can use conventional, DSCR, primary, or a secondary home loan. The tax man does not care if you close in your personal name or a single member LLC, right? Whether you close in your personal name or a single member LLC, you're still going to get the same tax treatment and the same tax benefit. So some people decide to close in their personal name and then later transfer to an LLC. And why would you do this? Well, you're going to get better financing options, better terms, a better rate in your personal name than if you would in an LLC. However, transferring the title or the loan from your personal name to the LLC can trigger what's called the due on sale clause, and the bank can technically call your note or make you come due with the balance. Now, I've never seen a bank personally do this, but they can. So if liquidity sort of dries up or there's a run on the bank, your note can be called. I've just never seen it actually happen. Again, not legal advice here, but this is what I've seen. Most people choose to close in their personal name for the better terms and the rate. Closing in your personal name will also be quicker than closing in an LLC. However, if you have a partner in your LLC and you go and borrow money or you go to buy a property, you will have to file a partnership tax return. So keep that in mind. So whether you close in your personal name or a single member LLC, no changes to you there from a tax perspective on what you're able to deduct and what you're not able to deduct, as well as the benefits. However, if you close in a multi-member LLC, be prepared to file an additional tax return for that. What about DSCR loans? So DSCR loans stand for debt service coverage ratio loans, and these loans are more of an investment grade style because they're based on the property's ability to service the debt. And so these are most common because there's no income verification that's needed. They will verify the cash that you have in your bank as well as your credit score, and you'll probably have to sign a personal guarantee. But more so, they're looking at that subject property's ability to service debt using a debt service coverage ratio. Most banks are going to look for 1.25 or 1. So if my rent is $1,000 and my PITI is $1,000, then it'll be a 1-to-1. It'll be a 1 debt service coverage ratio, and you'll qualify. Beware of a prepayment penalty, though, when it comes to DSCR loans. This will prevent you from refinancing or selling within a time period, typically within 3 to 5 years after you close on the loan. The DSCR loan is great for self-employed peeps like myself or irregular income folks that can't prove a track record of income but do have the cash in the bank. The downside of DSCR loans is that you are going to have higher rates, lower quality terms in a DSCR product than you would a regular conventional loan. But if you're self-employed and you don't have your 2 years worth of tax returns to be able to do a conventional loan, it's a great way to get in the game. I mean, I've done DSCR loans just because I haven't had 2 years worth of business tax returns to show my self-employed income. A bank statement loan is very similar too. Similar to DSCR, all they're verifying is, do you have the cash in the bank? Do you have your reserves built up, right? 6 to 9 months of reserves. They'll check your credit score. They'll make you sign a personal guarantee. And it's great for people who are self-employed or don't have a stable or good income. The secondary home loan is where things get a little bit interesting. So a secondary home loan is where you show the bank that you have the intent to actually use the property as a secondary home or a vacation home. And what's nice about these loans is you can put as little as 10% down on these properties, although I think the 10% down funding is kind of drying up a little bit, but I do know there's still some banks that do this. Some lenders will allow you to use them for a rental. Some of them won't. And just keep that in mind. You will get the best rate or terms out of any loan with this secondary home loan product. You want to be aware of two different rules when you're using this loan. First is going to be your lender's requirement. Some lenders want to see that you're using the home as a secondary home loan. And the way that you're able to prove this is actually on your tax return where you list out your rental property or your property. There'll be a personal use day box that you'll be able to put in how many days that you use it for personal use. And most lenders want to see that you've actually used it for 2 weeks, personal use, 14 days. However, the IRS has a rule where if you use it for more than 14 days personal use, you're going to be limited to the amount of deductions that you can take. And so that particular rule is found in Section 280 Cap A, and it says the greater of, and if you know you're in the tax code whenever you hear the greater of, but it's 14 days personal use or 10% of the total rental days. So if I rent the property out for 200 days, I would theoretically get 20 days personal use instead of the 14. But if I rented it out for, let's say, only 100 days, I would still get my 14 days of personal use. And so just keep in mind when you're using a secondary home loan, you want to be able to meet both parties' requirements, your lenders as well as the IRS. High-level strategy here with the loans, guys, is if you have good liquidity, which may not be optimal right now, especially when bookings in some areas are down and all of our carrying costs have gone up. It's more expensive to heat your home, keep electricity, keep the gas. Me personally, I prefer to put as little down as possible, assuming that I have the carrying costs, right? Assuming that I have 9 to 12 months of reserves for all my rental properties or my business, I prefer to put as little bit down as possible. The reason why is you are using leverage. And so it doesn't matter if you put 10, 20, or 100% down, you still get the same amount of appreciation on that property and the same depreciation or the tax benefit. And in fact, the lower money you put down will actually boost your cash on cash return because you're going to have the same net operating income before debt service, regardless of if you put 10 or 20% down. Putting 10% down will boost your cash on cash return. If you have a mortgage in your personal name, consider refinancing in your personal name before transferring it to an LLC or a business entity. You will get better rates and terms in your personal name, and you'll be able to close quicker than having it inside of that entity. Keep in mind the 10 conventional loan limit per person. Every person is allowed to have 10 conventional loans in their name, and then after that, most people look to do DSCR, bank statement loan products, or they do portfolio loans. Self-employed people, I know the bank statement loan and the DSCR loan can be tough because you're probably going to pay an extra percent or 1.5% and lower quality terms. But if it's your only option to get in the game, go ahead and do it. I've done it, and rather than waiting 7 or 8 months to get your tax returns done, you're able to get in the game quicker. One of the questions that we had regarding this subject was, what is too much leverage? And to me, that is going to be person dependent. It's going to be dependent upon your income. Do you have a stable income? If you lost your job or your W-2, can you go get a new job by the end of the month? Does your spouse have an income? What is your total household income relative to the amount of debts that you're having to pay off? Not just your rental properties, but do you have car loans in your personal name? Do you have credit cards? Do you have student loan debt? Me personally, I'm willing to take on leverage. I have over $1 million in debt, but I also have over $1 million in assets owned, right? To me, leverage, as long as I can have 9 months of carrying costs. So 9 months, if my properties make me absolutely zero money, I'm going to be able to pay those mortgages or pay those bills. 9 months to me seems safe because I know that I can go and make that in my business. But for you, if you have, let's say you have irregular income or lower income, you may want your carrying costs to be much higher, maybe a year. So that's it for today's episode, guys. We talked about how financing affects your tax situation. It doesn't really at all. But I just wanted to bring conversation to this topic because a lot of people have had questions about, hey, do I, primary home loan, secondary home loan, DSCR, what does it matter? What does it mean to me? And just wanted to touch base on this podcast episode today, guys. If you have questions about this topic, feel free to reach out to me at Learn Like a CPA on TikTok, Instagram. And if you like this podcast especially, make sure you leave a review wherever you are listening, whether it's YouTube, Spotify, or Apple Music. Thanks, everybody. I'll see you guys in the next episode.